Danny buys a rental house. Ray buys nothing. He just clicks a button. They both walk away certain they made the smarter move. And they're both wrong, because one of them forgot to count the hours, and the other one forgot to count the zeros. Let's make this completely fair. Danny and Ray are both 32. They both bring home $58,000 a year. They both have $60,000 saved, and the only thing separating them is what they do with it. Danny puts his $60,000 down on a $300,000 rental, 20% down, 30-year mortgage at 8%, a payment of $1,760 a month. He finds a tenant paying $2,100, which means $340 a month walking straight into his pocket. Danny feels like a genius. Ray drops the same $60,000 into a total market index fund. No leverage, no tenants, no keys. He sets up $400 a month on automatic, and then he forgets about it. His coworkers ask what he's investing in. He says index funds. They nod and they change the subject. Nobody is impressed by Ray. Day one, Danny has a house, a tenant, and a story to tell at dinner. Ray has a confirmation email. It isn't close in terms of how it feels, but feelings and math are two completely different animals. And if you've ever stood at this exact fork, wondering whether to buy the property or just keep clicking buy on the fund, stay with me. Because in the next 13 minutes, I'm going to run both lives out to year 20 and hand you the number nobody puts on the thumbnail. Subscribe if you want the version of money advice that shows the receipts instead of the highlight reel. For the first few years, Danny is living it. Rent lands on the first. He drives past the house on the way to work and thinks, I own that. He's writing off mortgage interest and depreciation, shaving a couple thousand off his tax bill. Every payment builds a little equity. Every house on the street ticks up in value. All of it feels solid, tangible, smart. Ray logs in once a quarter and watches 60,000 become 67, then 75. It doesn't feel like anything is happening at all. But 3 years in, let's actually run Danny's numbers. He's collected roughly $75,600 in rent. His mortgage payments came to $63,300. That leaves $12,300, which sounds excellent until you subtract everything else. Property taxes are $3,600 a year. Insurance is $1,800. He replaced a water heater for $1,400, fixed a leaking roof for $3,200, and ate 1 month of vacancy that cost him $2,100 in lost rent, plus $700 to clean and relist. He manages the place himself to save money, which means calls at 11 at night, weekend showings, and coordinating a plumber on his lunch break. After every real cost, Danny's actual net cash flow across 3 years lands somewhere between $2,000 and $4,000, not $12,300, and that's before you count a single hour of his time. Here's the test he should have run before he ever signed. Multiply the purchase price by 1%. On a $300,000 house, that's $3,000 a month in rent. Danny is collecting $2,100. He bought a property that failed the math before the first tenant ever moved in. And he did it because the house looked nice and the numbers looked close enough. Close enough is where landlords go to die. The rent check is the number everybody talks about, and it's the number nobody survives contact with. Here's what comes out of it before you keep a dollar. Vacancy. The average rental sits empty about a month a year, and that's a full mortgage payment with nothing coming in to cover it. Maintenance. The working rule is 1 to 2% of the property value annually. So $3,000 to $6,000 on Danny's house. Some years, that's a $200 faucet. Other years, it's an $8,000 air conditioning unit in August, with a tenant threatening to leave. Then capital expenditures, which are the ones that actually break people. Roofs last 20 years. Furnaces, 15. Water heaters, 10. Those aren't maybes. They're guaranteed future bills that arrive in chunks of $5,000 to $15,000. And if you're not setting aside $250 a month for them, you don't own a business. You own a bet. Then management. Hire someone and it's 8 to 10% of rent gone instantly. Or do it yourself. And you've handed yourself a part-time job that doesn't pay. And then the one nobody says out loud. A tenant who stops paying and knows exactly how slow the eviction process is can cost you 3 to 6 months of rent plus legal fees. One of those wipes out an entire year of profit. So write this down, because it's the number Danny never calculated. Take your annual rent, $25,200. Cut 25% off it for vacancy, maintenance, and capex, and you're at $18,900. Now subtract taxes and insurance, $5,400, and you're at $13,500 a year in true operating income. Divide that by the purchase price, and you get 4.5%. That's the number. That's what the building actually earns before the bank takes its cut. Every serious investor runs that calculation in 90 seconds. And almost nobody on the internet showing you their rent check has ever run it once. By year 5, Danny is on his third tenant. He's replaced the roof for $9,000, handled a $1,600 plumbing emergency, and eaten another empty month. He's raised rent to $2,250, which helps. But his taxes went up, and his insurance went up more. His real cash-on-cash return, money pocketed against money invested, is hovering between 3 and 5%, not the 15% he told everyone at the barbecue. And here's the cost that never shows up anywhere. He's spent roughly 100 hours a year on this. Screening, showings, repairs, calls, paperwork. 500 hours over 5 years. If his time is worth even $30 an hour, that's $15,000 of unpaid labor quietly deducted from a return he's still bragging about. Ray, meanwhile, has done nothing. By year 7, he's sitting between $160,000 and $180,000. He never picked a stock. He never timed a dip. He just didn't touch it. And not touching it was the entire skill. Because the thing about Danny's wealth is that it grows in a line. Steady, visible, and demanding attention every single week. Ray's grows in a curve, boring for 5 years, and then genuinely alarming for the next 15, because the gains start earning gains, and the whole thing detaches from what he's putting in. By year 10, Danny's house is worth about $400,000, and he owes roughly $200,000. So his equity sits near $200,000. Ray's portfolio is at about $210,000, dead even. Except Danny got there carrying $240,000 in debt, concentrated in one building, on one street, in one zip code. And if that street goes bad, if the major employer in town leaves, if the city reassesses his taxes, he cannot sell in an afternoon. Ray owns a slice of thousands of companies across every industry on Earth and can liquidate the whole thing before lunch. Push it to year 20, and the story finishes. Danny's property is worth $550,000 to $600,000. His mortgage is nearly gone, and his equity is around $500,000. After 2 decades of repairs, turnover, taxes, insurance, and at least one full renovation, his total profit from rent above what he spent is maybe $50,000 to $80,000. Ray's portfolio, at 10% average with $400 a month, sits at roughly $520,000. He contributed $156,000 of that. The rest appeared out of nothing. They both end up at $500,000, but Danny worked for his and Ray waited for his. And that distinction is the whole video. And here's the lever most people never pull. If Ray had raised his contribution by just $200 a month, $600 instead of $400, his 20-year number crosses $650,000. In the market, adding money multiplies because every dollar you add gets 20 years to compound on top of everything already compounding. In real estate, adding money means another house, another mortgage, another set of tenants, another roof, and double the work. That asymmetry is the single most underrated fact in this entire comparison. And it's why the passive path quietly wins the second you start feeding it more. Now, if I only showed you that side, I'd be doing exactly what every stock guy on the internet does. So let's be honest about Ray. Stocks are brutal. The market fell 37% in 2008 and 34% in a single month in 2020. And if Ray had watched $180,000 turn into $115,000 in 3 weeks, that's not a number on a screen. That's a gut punch. The data is clear. Most people panic sell at the bottom and buy back near the top, which is how the average investor underperforms the exact fund they're invested in. An index fund never mails you a check either. The dividend on a total market fund is around 2%. So on $200,000, that's about $300 a month. That's not replacing anybody's income. And Ray used $60,000 to control $60,000, while Danny used $60,000 to control $300,000. 5-to-1 leverage. That is enormous when prices rise. And it's the single reason real estate has minted more millionaires than the market in survey after survey. Then there's the tax code, which openly favors Danny. He deducts the theoretical decline of a building that is actually going up in value, and Ray has nothing remotely like it. Real estate genuinely wins in specific, identifiable situations. When rent clears 1% of the purchase price. When you treat it as a business, screening properly, budgeting capex, building systems, instead of a side hustle. When you house hack, living in one unit and renting the others, which can drop your own housing cost to nearly zero, and is something the stock market can't do at any price. When you understand a 1031 exchange and roll gains into the next property without paying tax on the way, real estate isn't a bad investment. It's a misunderstood one, and the people it destroys are almost always the ones who bought the story instead of the spreadsheet. So run the checklist before you commit either way. Know your real number, not gross rent, but rent minus 25% for vacancy, maintenance, and capex, minus taxes and insurance, and only then compare it to the mortgage. Price your own time honestly, because 100 unpaid hours a year is a second job you've agreed to work for free. Ask whether you'd be comfortable holding this thing through a 40% drop or a 6-month vacancy, since both are ordinary, not rare. And if you go the Ray route, understand that your only real job is automating the contribution and then never intervening, because every instinct you have during a crash will be the expensive one. Danny and Ray both walked away from that decision, certain they were right. Danny believed real estate was the proven path. Ray believed the market would do the work for him. Neither of them ever sat down and mapped out what it costs, in dollars, in hours, in stress, in what they gave up to hold it. The trap was never real estate, and it was never stocks. The trap is picking one because of a headline, a podcast clip, or something your uncle said at Thanksgiving, without running the numbers for your own life. If this gave you a framework you didn't have 13 minutes ago, hit like. It pushes this to somebody who's about to sign a mortgage they haven't calculated. Subscribe for money breakdowns that show the full math, not the highlight reel. And tell me in the comments which one you'd pick and why. Next time someone tells you real estate always wins or the market always wins, ask them for the spreadsheet.